All right, party people. It's time for another live underwriting session here. We're going to wait for us to get connected to all of our live streaming platforms. It looks like taking a little bit of time to get up and running with LinkedIn. So we'll give a few seconds here. But for those of you who are new to this is a live hotel underwriting session that I host once per week. And I am more than happy and willing and able to underwrite your deals. So if you're looking to have a hotel underwritten, it must be a branded asset. No boutiques. Just don't really want to do that. And there's too many unknowns with the boutiques. So it would have to be, I could do that for you, but I would have to do it on the side, not for the lives. So branded assets, happy to take a look at those and underwrite those for you live. Today, we're going to do a really special one. Not a really special one, actually. This one is, there's actually nothing special about this one. But it is a Marriott limited service asset in Tennessee. I consider the city to be, I'm not going to give away the city because it would probably give away the asset. Tier 2 city. This was on the market a couple of years ago. Again, I don't like to do anything that's recent because I've signed NDAs for a lot of these. This is the exercise of it all. I want to take you through my methodology, my thought process, so that if you are new to underwriting or you're just curious about how I look at things and how I assess certain situations. That's what this is for. This is for educational purposes, and it doesn't need to be a hotel that was listed 2 days ago for this for it to be educational in nature. So, with that being said, let's go ahead and dive into this one. Like I said, Marriott limited service asset. It does have an F&B component, food and beverage component. So there is a bar. And there is, but it's not open all the time. There is breakfast served, and so you'll see the F&B is not profitable on this one. It's pretty common for these sorts of things, and so as an operator, for the operators, because I wouldn't be operating this myself. For the operators, one of my questions would be, what's the game plan to kind of turn the ship around on the F&B to make it profitable again? Because we can't be running at a loss. And granted, the free breakfast is probably what's causing that, but there should be enough margin on the paid F&B to mitigate the free breakfast overhead. So with that being said, let's dive into this. I don't want to spend too much time on the philosophy of it all. Let's go ahead and dive in. So you'll see here, this is my model. It's the model that I've used for quite some time now. And this was actually being shopped as in a pack. So there were a few hotels that were being shopped, grouped together, and this was one of them. But the buy it alone price, at least, what they said it was at the beginning, was around 9 million. So let's just go ahead and put 9 million here. Brand application fees for this one would be about 200,000. Broker fees on this one were going to be about 150. About 150. And the due diligence costs, let's just put that at, this is whatever the sponsor was going to do for due diligence. So maybe around 75 grand, and closing costs, maybe another 75 grand. Okay. So we've got all of our fees in there. Okay. And now let's go ahead and go through the star report. So this hotel ADR was at about a 105 T12. So we're going to put 105 here, and its occupancy was running at a 73. Okay. Keys. This is a 93 keys on this one. Okay. Now, interestingly enough, and this is one of the things that actually, one of the reasons that this was a hard no for us was, I know I gave it away. One of the reasons this was a hard no is because even though it's technically maybe even considered a tier one city, the real estate in this particular market is very wonky. And without giving too much away, and that this is the hard part about doing these sorts of live underwriting sessions. In a private setting, I could be way more transparent and give a lot more detail. But without giving too much away here, even though these hotels were in a good part of town, the majority of the city is not particularly safe. And so I might give it away, honestly. And the real estate cap rates were all over the place, just depending on what part of the city that you're in, et cetera. And so it was really hard to kind of like come up with an exit cap. I settled at a 10. I could see it going for like a 12. Seller, I think, was trying to sell it for a 6, right? So yeah, seller was trying to sell it for, I think NOI on this thing was, let's see, NOI on this thing was what are the replacement reserves? Yeah, I think this is EBITDA, but there's no replacement reserve. I think that was another thing too. They just didn't even bake those in, which is hilarious. So yeah, 693, but minus the 4% replacement reserve, which would have been like another 100 grand or so. So you're at like let's just call it like 570, right? Divided by 9 million. Yeah, 6 cap. Yeah, 6 cap. So one of the biggest reasons, right? There would have had to been a huge discount. And I'm sorry, even though it's a Marriott, there's no way that this thing should be trading for a 6, especially not in this market. We're not even really seeing 6 caps in like Manhattan right now, or like any of the major cities. Maybe once in a blue moon if there's like no PIP needed, no renovations, no nothing, right? So anyways, let's go back to this. I'm going to put this at a 10 cap. Right. And by the way, like, how do you assess that? How do you determine the exit cap? Well, you need to know the markets, right? So you need to have access to CoStar data if you don't know the markets, or if you do know the markets, right? If you're in tune with kind of like what's going on in those areas, and you can kind of like guess or guesstimate. Another great way is like if you have a great broker working with you, you can kind of bounce ideas off of them, whatever, right? F&B revenues. So let's look at the P&L. F&B revenue, 128,000. And this was one of the things that I was like, okay, we got a full bar, and we're only generating $128,000 in revenue on a 93 key asset with a full bar that's running a 73% occupancy. That's horrible. That's just awful, right? So right there, it tells me lack of operational competency. These people are just kind of like it's whoever's running this show, and I know who the owner is, um, either doesn't know what they're doing or they're too rich to care. He's the latter. So F&B revenue, we're looking at a 128. Yeah, he's too rich to care, but I'm not. And neither are you. 42,000 in other revenue. Where am I getting that? Just right here, guys. These two line items right here. Okay. This is select service asset. We should be running a 30% margin on this hotel. No questions asked. And that's even with the F&B guys. Because really, we're doing a free breakfast. So the free breakfast is going to eat into our margin. And the F&B should drive enough profit to not only overcome that, right? So we don't just run it at a loss, but even run a slight profit on the F&B. Okay. Down payment. We're going to bump this to 40. Interest rate, we're going amortized. It's a 25-year AM at a 7.5% rate. We're going, let's see, lender fees on this would be around probably like 70K or so. Maybe a little bit more, maybe a little bit less. And by the way, if you love boba, I love you. Interest rate or interest reserve amount, we'll just keep that at 0 right now. Okay, so this particular asset allegedly did not require a PIP. Now, we all know that when they say that there's no PIP required, that's not, the lie detector test determined that 2 was a lie. So when there's no PIP, quote unquote, necessary, we still want to bake in a very nominal, very, very nominal PIP allowance, right? So conservatively, I would say 10K a key, but I feel like for something that they say doesn't need a PIP, we might be able to bring that down to like 7K a key, right? So 7,000 times 93, we're at 650,000 on the PIP. Okay. Let's just go 50,000 on the reserves, just for a little bit of buffer there. Now, keep in mind that if we're going to be doing this might be lobby. This maybe if the rooms need a slight refresh, there's a piece of furniture or whatever that needs, we're not going to be taking any rooms offline, so there will be no displacement. And that's very important because when we're underwriting a value add asset, we want to take into consideration, what's the displacement going to be, and over how many months or years is that displacement going to impact our rooms revenue. But we don't need to take that into consideration here because we should be good to go. Okay. Now, these are some of our base level assumptions. These are very generic assumptions, and it really depends on the market, the asset type, what kind of hotel, whether it's the brand and the asset type, right, are both very important here. So that being said, we want to look at what's our rooms expense here. Oh, well, that's not helpful. All right, so what do we want to do here? We're going to make a really simple formula. Oops, divided by that, and we're going to, great. Okay, now we're going to make, oh, no, making this percentage, and we are dragging and dropping. That's really, and Where my spreadsheet nerds at? Let's go. Good. We now have our expenses expressed as percentages here on the right. I hate it when they don't do that, man. It's sloppy. It's sloppy. So they're running a 25% rooms expense rate. Our estimate on an extended stay, or sorry, not on a select service, limited service asset would be somewhere around 24%. So it's a little high. Okay. Our F&B. Now, actually, sorry, this should be expressed as a percentage of, oops, goodness, divided by, this is 186%. Okay. And then this should be expressed as a percentage of this, maybe 78%. Notice how we're a lot higher than our expectations here. The F&B being 186%. Now, like I mentioned before, the free breakfast is what's eating into that. But it's still no excuse, right? We should not be running a loss on our F&B. Like worst case, we're running it at a push, but it's being poorly managed. A&G is at 11%. Okay. That's way too high. So right here, so good news, bad news, right? When we're assessing these things. Bad news is it's being run poorly, right? Good news is there's upside here, right? Because we can actually drive some of these expenses down. So when I'm looking at these, I'm underwriting it for what it's doing right now. And then what I think the hotel could do by like year 3, we should be able to get A&G back down to like that 6 to 8% range, right? IT, and okay, so this is where all the fun kind of happens, because notice how they don't have an IT item. So now we have to figure out, okay, well, where do they put IT? Maybe they put IT in A&G, and that's why it's so high. We'll come back to that. Sales and marketing is at a 2.5%, right? So they've got this at 2.5. We're just going to put this at 0 right now because there's no IT line item. Franchise fees are at 11.5. No. What happened here? Oh, there we go. Property maintenance, repair and maintenance, 4.5%. Utilities, 4.7%. Taxes are at 3.4. That's a good old Uncle Sam. Thanks for nothing. And 3.5% on the insurance. Okay, we're going to assume 1% inflation, which is actually pretty low, but you'll see it's kind of a net wash here. So I'm not super worried because the the model increases expenses and revenues kind of equivalently. We can go in there and kind of adjust things though. Occupancy growth, we'll just keep that at 1% for now because we're going to overwrite it. And then we're going to say April 16th, underwriting. Great. Yeah. What is this? It's supposed to. Delete. That was there for another time. Okay. So yeah, they must have put IT. I'm guessing that they looped IT into A&G, which is why A&G is so high. And actually, we can actually, without spending too much time, let's see if we can figure that one out. So, IT technology fees now. Okay, rooms expense. Boom, boom, boom. Restaurant. So I'm like looking over here. Well, actually, so notice how the breakfast got put into the rooms expense. So that's a lie. I lied to you guys, which makes it even more absurd that F&B is running at that kind of loss. And what happens here, guys? So like, there's a lot of fixed expenses with F&B. You've got the labor, right? So if you've got a bartender, you've got servers, you've got, kitchen staff, whatever. Those are all fixed expenses for the most part. And so I'm not super, I mean, it's just very poorly run F&B. All right. Where are we going here? Banquet, no. Angie. Okay. Let's see. No. I don't know. IT somewhere. I could figure it out if I really wanted to, but it's not that serious. Okay. We'll figure it out. We'll figure it out. So, all right. The good news is, good news, bad news. Bad news is it's not being run optimally. The good news is that means there's meat on the bone, right, to kind of extract. The other good news is, this is, if we look at the star report, we look at how we're doing compared to the other assets. We're running a 103 index on the RevPAR, which means we're performing above the comp set on revenue per available room. That's good. Is there room to grow? So what is the data telling us? The data is telling us that we are underpricing our rooms. Yeah. Comps are at 113, 114, we're at 105. And we're underpricing to kind of drive occupancy. All right. Clearly that's the strategy that they're currently using. Cool. And they might be doing that through OTAs on online travel, so like Expedia, Priceline, all that good stuff. So then we got to figure out, okay, well, how much more meat can we kind of juice out of this thing, right? And when I say we, I mean like whoever's operating this thing, right? Yeah, we got to figure out like how much more juice can we extract on. So this is where I want to focus on occupancy. We're already kind of at the top of the market. I think expecting more than 1 to 2% growth over the next 5 years would be irresponsible. Like that would be a very irresponsible projection. So what we want to do is we want to keep this tight, right? We want to keep this around 73.2, maybe 73.5. Again, we're just kind of this is a bit, guys. I'm not spending like on a real model, right? I'm spending hours and hours and hours on this, right? So we're just kind of we're doing the ballpark estimate here to see if it's a go, right? If it's worth digging into more, it's worth digging into more, then great. Then we'll spend more time looking at the numbers, making sure that we're dotting our I's, crossing our T's. And then maybe we go 75 here, and then that's it, okay? And then from there, maybe we keep it at 75 or so, okay? And then our rate. So let's see where the market's at. It's at 113. We're projecting, we're not even getting to 113 until 2033. That's a really conservative estimate. So what I want to do is we're going to increase rooms revenue by 2%, okay? By 2%, so we're getting to 113. This is a decent growth projection given where the market's at. We're getting to where the market currently is by 2029. Yeah, there's no PIP, so there's not going to be a tremendous amount of value added to the property. So I'm comfortable. I'm comfortable with this projection, at least for now. Okay. So now let's look at our pro forma. Let's just make sure that all the numbers kind of mapped in here correctly. Looks right. This all looks right. We've got 93 keys. All right. So, all right. This is our base model. If nothing changes, this seems to be where we're going to be at, right? F&B, we're kind of pacing to stay at about a 180. And then rooms revenue, it's going down a little bit, right? We're getting to 24. I'm comfortable with that. We're going a little too aggressive here on the expenses. Maybe we bring this up to 1.2% on the rooms just to see. 24.1, 23.9, 23.7. We go 1.5 here. Okay. Yeah, that's good. We're keeping it around 24. Okay. And our A and G, 10.9, 10.8. Yeah, that's solid. That's fine. Our IT, non-existent. Okay. Now, one sneaky thing. Now, this is something, guys, you got to look out for this. Like some operators are super sneaky, sellers are super sneaky. If you notice, like where on this P&L, and I might be blind as a bat, It's been a little while since I've looked at this one. I don't see a replacement reserve here. Do you? All right, so we've got our EBITDA, but that's before replacement reserve. So they're running this asset at a 20% margin post replacement reserve, and they're sharing staff across hotels. Because we found this out later that they're sharing staff with this. So now I would find it hard to believe that they're putting some staff, some payroll exclusively on this P&L, particularly because this is what they shopped to the market. So if anything, they would actually kind of take out some of the expenses here and put it into another P&L to kind of hide it. Not saying that that's something I would do, but sellers would do that, and especially people that are, um, sneaky. So that's one thing here. It's just like, come on, you don't even have a replacement reserve line. It's hard to take a seller seriously, honestly, when they have financials that look like this. This looks like it was generated via QuickBooks, to be honest with you, right? Um, I don't know. Um, I don't know who's managing the asset. Actually, I do know, but I'm not going to say. It's just bad. It's just really, really bad. Okay, so let's come over to our assumptions here. And without any sort of split or anything, this is what we're looking at on our internal rate of return and equity multiplier over a 7-year hold period. I generally, to start, I look at things from a 7-year hold. If the sponsor doesn't give us a hold period, like if there's obviously they're going to tell us like 5, 7, 10, whatever. But if I'm just looking at something myself before the sponsor gives us like a business plan or whatever, I'm usually going 7 years. 5 years can be a little tight to run for something to run its course. 7 years is a little bit more time. 10's a long time. So 7, we're at 14.27, and let's see. Okay. Now, what we want to do is we want to figure out, okay, well, is there meat on this bone, right? What needs to happen, okay, for us to get comfortable with the deal? Well, really, there's only two things I think here on the pro forma that stand out to me where it's like, all right, like I could see some significant improvement here. First thing I'm going to do though is I'm going to add back in some IT, right? I'm going to strip out 2 here, and I'm going to bring A and G to 9, okay? And it's just going to make it easier for me to just kind of like work the numbers. Because what I want to do is I want to see, okay, if we get A and G down to 7, right, maybe 6.5, and then we get F and B to 85%, which means we need to drive F and B top line, right? So where I see some potential here, and again, this is kind of like, it's not that great of a deal where like one of the biggest levers is going to be on the F&B side of things. I'm not saying that there aren't deals out there where that makes sense, that but still, it's kind of like it's not the most ideal. Also, the franchise fees. I just want to point out, franchise fees. Well, no, marketing and franchise fees together are going to be around 14%, and that's a little high. That's a little high, but we're just going to keep that where it is and not do too much with it. utilities typically and property maintenance, we're not going to do a lot with those line items unless there's something that we know that we have like an inside scoop on or whatever. But I just don't see it, right? So, okay, so inputs, what are we going to do? The first thing we're going to do is we're going to assume that over a 3-year period, we can double, sorry, let's look at this pro forma. 128, so over the course of 3 years, we can go like 2.25, like 200-ish, 225-ish%. Like I'm thinking, like a really like solid win would be to get this thing to like 325, 350 on the F&B top line. That's almost tripling the F&B revenue. That'd be tough, right? And then bring down the F&B expenses to about 90% of our top line revenue, right? So how are we going to do that? Well, I got to work the model here a little bit. And this is just, we got to play with the numbers. But let's say that we're increasing, let's say that we increase our food by 40%. And then we go back 1, and then 30, 20, and then 3. So let's see what that does. 120, 180, 230. No, we got to go a little bit more aggressive, right? But there needs to be a solid business plan. And so like that's what I'm saying, like we're modeling for this, but only if there's like a legitimate plan in place, right? Not like, hey, we kind of sort of wish that like we could get no, none of that. Like there needs to be a definitive, like this is what we're going to do. But we're playing hypotheticals here. Like we're pretending like that plan has been presented to us and that we're, or that you've come up with that plan, right? If you're operating the hotel, we're going to assume that there is a strategy here, right? Because spreadsheet is not a strategy. So. $230. So we're at 120, 270. Yeah, this looks good. I would say that maybe we go just 1% here on the. Yeah, let's do that. And then on our expenses, we're maybe going to increase here 10, 10, 10, and 1, and then keep this at 1. So you'll see like go here, 60. Yeah, maybe we'll go 10. Yeah, sorry guys. I mean, this is like the only crappy part about this model where we gotta kind of just enter these percentages. I can also manually override, but then it gets really confusing. That's exactly what we wanted. Boom. Look at that. I've done this a time or two. All right. So now we're exactly where we want to be. We're at about a 90% or 10% margin on the F&B, which is fine. And we've brought our F&B expenses down pretty significantly. Our miscellaneous income, we're just going to keep that where it is. I don't know what is going on there, why it's as high as it is. Usually miscellaneous income should be pretty profitable, right? Whether it be the mini bar, not the mini bar. Oh my God, I'm blanking on the little food court area out there, right, where you sell, um, you know, a 10-cent candy bar for like $10. Um, those are usually pretty profitable. So I don't know. Anyways, last thing here before we look at the waterfall. And so A and G, we're going to bring this down. It's already come down to about 8%. So we're just going to bring these expenses down on the A and G by like, oops. Oh my gosh. Down here and pro forma. Let's come down to the A and G. Just want to highlight this so I can see it. I'm old now. That's still not good enough. We want to bring that down even more. So let's just go. So let's just say 0, 0. Yeah, yeah. Okay. That we're getting it down to kind of where we want it to be percentage wise, but it's still not ideal, right? So it's almost like we'd have to drive down. We'd actually have to like cut expenses, which is fine. We could just say like -1, right, percent, and then we could really drive it down. And that's kind of what we're going to have to do here. So -1, -1. Oh, there we go. That's why it's not going. So after a year, yeah, 7, 2032. So year 7. Yep. Maybe one more here, just to really dial that in. Yeah. Okay. We're in a good spot. I don't think that we need to like over obsess over this, but that puts us at now. Just to look at this, right? Like we're still. I mean, we're finally getting up to about a 30% margin by year 7, right? Which is good. Like that's where. So now we've gotten it back up to where we know we can. Should it be a little bit faster than yet? That than that? Yes, it should be, right? But like, look here, we're at year 7, right? And we're at a 30% margin. Cool, including replacement reserve. Now, could we get there in 3 years? hopefully, but that's extra gravy, guys. Like we cannot underwrite, assuming like, hey, by year two, we're gonna have fully executed the business plan and we're going to be able to get to the margins that we know that we can get to. That's just irresponsible. It's just irresponsible, and I would not recommend it. Okay, so now, like now we're at getting a little bit, like we're getting a little somewhere, right? Let's. By the way, what are we at here? We're at like a million NOI. So if we're at like 1 million NOI divided by 10 cap, yeah, so we're like a $10 million exit, 10.2. Seller wants to sell it right now for 9, and we've injected all of this value. We could sell this hotel to an institution. Right now, no institution is touching this thing, right? It's being run horribly, right? So there's no private equity group, no one's coming to save you, right? Only a smaller operator that that has something to prove really is going to take something like this on, or maybe a medium-sized operator that has a portfolio or like has other things in the portfolio in the area. They can, economies of scale, inject some more value into it via shared staff, and they know the market really well. Like I could see maybe somebody like that going after it, but like this, the way that it's mapped out on the pro forma now, this would be, start to be something that like, yeah, you could potentially sell off to an institution and maybe even get it down to like, say like a 9 cap, right? So let's assume institution wants to buy it now and they want to buy it at a 9. So we've built in a little bit more value there. And notice how at a 10, right? So we do get a little bit more juice. There's a little bit more squeeze there. Okay, so last couple of things. So these are the terms. These are terms that I've seen before. So I'm like, all right, as an LP over a 7-year hold period, you're going to get a 17% IRR and a 2.1% multiple. You might be looking at this as an LP and saying like, yeah, that looks good. For this kind of project, if we're not seeing internal rate of return on this is best case scenario, by the way. Remember, in the low to mid 20s, it's not worth the risk. It's just not worth the risk. There are better deals out there, so this is not good enough, right? And I can almost like there's almost nothing we could do now, right, to get it there now. 17.39, we're here, like let's just bring this out. So okay, all right, last thing here, as anyone who's investing alongside of me in this deal, we're coming in with let's just say that we're coming in with a $2 million check. That's half the equity required for the deal, basically, right? We need about 4 million in equity to do the deal. So if we're coming in with a $2 million check, I'm gonna probably ask for like, like let's say this was an 8, right? So this is probably an 8 pref before. Then I'm gonna negotiate a 10 pref, right? And then maybe I can get this up to 16, right? 10, 16, and 20. And I'm gonna say, hey guys, like anything over 16, like we'll do a 25 over 16 and a 30 over 20. So you're getting to your 70-30, but only after we get over a 20% IRR. Like obviously it doesn't really impact us too much because we're so low on the internal rate of return. Cash flows look decent, right? If you're an investor, you probably like that. But the truth is there's not a lot of CapEx on this thing. So our depreciation isn't going to be a whole hell of a lot, especially not like accelerated depreciation. So, you're going to get taxed on that income. It's not going to look as good as it does here. So I always like to do this just for fun, right? Let's see, what would the price need to be if what would the price need to be? So we want to bring this to 22. We want to bring this to 22%. Oops. And we want to do that by changing this cell. What would the price need to be in order for us to get to our 22% internal rate of return? And it is about 7.4. So if the sponsor, if you could magically get this down to about like in the low sevens, right? Purchase price, it's a deal. This is a deal. It's worth buying at that point. And that's even assuming a 10 cap, right? A 9 cap. Like, let's say that we can't get more than a 10 for it. Yeah, I mean, the IRR goes down a little bit. Still, maybe, maybe. And even still, we'd be doing the GPs a pretty solid favor by like doing this. We might be able to like negotiate something closer to that on the promote. Maybe even a 12 pref. I'm a good negotiator. We could figure it out. But yeah, something. Then we're getting to 22. That's it, everyone. That is our underwriting for today. Ultimately, this would be a no deal for me personally. There are better deals out there. There's just not enough. Like the business plan is we need to increase our F&B revenue and marginally decrease expenses on the A&G side of things, and maybe some rooms expenses and whatnot, which isn't a horribly difficult business plan, right? So that like plus side is not a horribly difficult business plan. The problem is that there's not that much upside there, right? Like if you execute the business plan, right, you could execute it and still not get to the margins that we need to get to, right, in order for this thing to make sense. So although it's not horribly difficult, sometimes that's where a lot of the money's made, right? Is in those those more difficult projects, and not saying that we're looking for problems necessarily, but there just doesn't seem to be a lot there, right? It's this would actually be a lot more marketable if it were already humming at around a 30% margin, because then you could just assume the operation, right? And you'd be good with like a 15-16% IRR on that kind of deal, because it's already running really well, and we just kind of got to go in there and be the new, and not screw it up. It's easier to buy that sort of thing and justify, a 7 or an 8 cap on the purchase. Sellers just want way too much money for this thing. Bottom line. So those are my thoughts. Feel free to leave your comments, questions, whatever down below. I'm here to answer them. And as I mentioned before, if you've got hotels for me to underwrite, you can send them to me. No, I'm not signing an NDA, so you can forget about it if you want me to do that. I'm doing you a favor because I'm doing it for free. This is Danny Gould, everyone, with Gould Capital, and I will catch all of you in the next live hotel underwriting session.